Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello friends, hope all of you are doing absolutely fine and preparing well for the examination. In this video, we will be revising quickly and thoroughly to ensure that you have a recap of all the important concepts that are required for the examination. So without wasting much of a time, let us start. First one is Ind AS 2 on inventory. Now as far as inventories are concerned, inventories comprise of finished goods, work in progress, raw material and supplies. The most important thing that you have to remember here is inventories are measured at lower of cost and net realizable value. Now what is cost? For cost we will include, what all will we include? We will include purchase price, we will include import duties and taxes. If they are refundable, we will exclude them. Then we will include transport and handling charges and any other cost to bring the inventory to present condition and location. We will deduct trade discounts, rebates and other similar items. So this is as far as the cost is concerned. Then when it comes to cost of conversion, direct material, labor and any other direct cost and overheads. Now when it comes to overheads, very importantly what you have to keep in mind is, then when it comes to overhead absorption, what you have to keep in mind is, if the actual production is greater than the planned production, we will recompute the ORR. What is ORR? Overhead recovery rate. Normally ORR is your budgeted overhead divided by planned or normal production. This is the normal formula. But if actual production is more, we will recompute the ORR. If the actual production is less than the normal production, we will use the predetermined ORR. We will not recompute the ORR. Sir, what about the balance overhead which is not absorbed? That will transfer to the P&L. So this is one thing important what you have to keep in mind. Then any other cost which is incurred to bring the inventories to present condition and location, this will be a part of cost of inventory. And borrowing cost, if it is a qualifying asset, then as per Ind AS 23, we will capitalize the borrowing cost as well. Okay. Then the next thing what we need to compute, net realizable value. Net realizable value is your selling price minus estimated cost to compute, estimated cost to complete and estimated cost to sell. So they will give you that selling price is 100, cost to complete is 20, commission on sale is 10. So 70 becomes your net realizable value. Lower of cost and net realizable value should be the value of your inventory. Sometimes for computation of NRV, if there is a firm contract with the customer, then that rate can also be taken. Then you have the concept of joint and byproducts. Joint products, they are two or more products which are produced from a single process using common inputs. Both the products are valuable. Byproducts are low valued products. Generally they are considered as scrap. Now what do we do with the joint cost? Joint costs are allocated on the basis of relative sales value or net realizable value at the split off point. What do we do with the byproduct? Whatever revenue you get from the byproduct, you will reduce from the cost of the main product or you will reduce from the joint cost. Then there are some cost formula which are prescribed, more important for MCQ purpose. Once in a while they ask, using the retail method and all, but otherwise it is not very important. Valuation method, inventories which are not ordinarily interchangeable, we will use specific identification of cost. If they are ordinarily interchangeable, then we will either use the historical cost method which is FIFO, weighted average, or we will use the non-historical cost, standard cost or the retail method. Now retail method is basically, you will take the selling price, you will reduce the percentage gross profit, then you will get to the estimated cost. Then when it comes to raw material valuation, whenever you get a question for inventory valuation, 100% they will ask for raw material valuation, and here very importantly, if the finished good selling price is more than the cost, raw material is valued at cost. But if the selling price of finished product is less than the cost, then you will value it at replacement cost, which is a representative of the net realizable value. Now don't take that it is cost or replacement value, whichever is lower, not that way. If the selling price is less than cost, then you will write it down to replacement value. Now this replacement value, if it is greater than cost, then you will always value at cost only. So basically, only if the raw material prices have fallen and also the finished goods prices have fallen, then you will value it at replacement value. Then as far as Ind AS 2 also specifically requires us to show what is the expense that is charged to P&L. So basically cost of goods sold is your opening stock plus purchases plus other manufacturing cost minus closing stock. This is the cost of goods sold.